Now for our special guest speaker for the evening. For those of you, he certainly is no stranger to this group. We were kind of reminiscing when he first spoke to our group, and I think it's just about 8 years ago. And I learned about Dr. Robert Goodman through his good friends, the Lashins family, Ed and Eric Lashins. And when they suggested that he come and speak about the economy 8 some odd years ago, I said sure. And he has proven to be a consistently engaging, knowledgeable, and I think his track record is pretty good at kind of calling what was going to happen and analyzing what has happened very clearly and in layman's terms that we can all understand. So I would like to call up our good friend and economist, Dr. Robert Goodman, to talk about the first 3 months of this year, the first quarter. If he wants to venture into anything about the Trump effect, if there's such a thing, there has to be, so the president usually weighs in on these matters heavily. And also maybe what we can expect for the rest of the year. Please welcome Dr. Robert Goodman.
Thank you very much. First I want to sincerely thank you for this invitation. In coming over here, I was thinking about how to begin. And quite frankly, the only sentence that came in my mind was the sentence from A Tale of Two Cities. It was the best of times, it was the worst of times. And that's exactly what we're facing. I also want you to understand, again, something I've said for 8 times now, every year. The job of an economist, certainly in the investment field, is not to predict. That's what they ask us to do. What's going to happen? We don't do that. What we're trained to do is explain what investors can expect based upon the policy actions of our government. Once you come to grips with what this government is most likely to do, irrespective of your political leanings, you must be objective. You cannot allow your individual ideology, liking, disliking, to get in the way of an objective assessment of what you're going to expect. Once an economist is given those critical assumptions, then and only then can he or she tell you what is the most likely environment in which you're going to exist. I've done this for 40 years. I can remember only one really comparable time. And it was in the early 1980s, when the possibilities were so profound for either an explosive economic and investment climate or total collapse. Back then, for whatever reason, irrespective of personalities, our government, because they had no choice, did the right things economically. And the rest became history. Not just in the economy, but in the markets as well. Both bonds and stocks. Not because we wanted it to happen. It's because they adopted the right policy mix. I know last year I talked about it, and I've talked about this for several years. We face a very interesting challenge in this country. Our economic condition is nothing like it was in the late 70s and the early 80s. Inflation is not our problem. We face a problem today that only a few of you in this room can remember, if at all. It goes back to the 1930s, when the problem was not inflation, but deflation, with the prices of things falling rapidly. Nothing scares a government more than deflation. And the reason is it feeds on itself. If you expect the price of a flat screen TV to be less in a week, you're not going to buy it today. And by holding back, that causes the price to go down further. It spirals down, and it is very difficult to get out of a deflationary environment. What we suffer from now is not a lack of supply. Our productive capabilities are fine. Don't let anybody fool you. What we suffer from now is a lack of demand. And I said it last year, I say it this year, and I will continue to say it. The good news, if there's any good news to be found, and again, please put the ideology away just for tonight. The good news is, finally, after 8 years, our government is talking about doing the appropriate thing by stimulating fiscal policy. Our Fed is out of bullets. We pushed interest rates in this country literally to zero. They are negative in real terms around the world, where the monetary authorities have been trying to get the economy going by reducing borrowing costs to zero, and they can't do it. We've been stuck in a very slow growth environment for 8 years. You want an analogy that you can use with your friends so they can relate to this? It's like being in your automobile in snow, and you're pushing on the accelerator, and the wheels are spinning, and the harder you push on the accelerator, the faster the wheels go, and you go nowhere. You can't get traction. Under those conditions, what are you supposed to do? Put something under the wheel. Well, our government is finally talking about policies that literally would put something under the wheels of the economy, to give it some traction, to give it the real chance of accelerating from 1 to 2% growth to something that's somewhat faster and for a prolonged period of time. But here's the problem. It isn't enough to talk about infrastructure spending of $1 trillion or tax cuts if at the same time you're talking about paying for that infrastructure spending or for those tax cuts by cutting spending here and raising it there, or cutting taxes here and raising taxes there. You'll spin your wheels. And this, folks, is going to be the debate that we are going to be living through day by day. You'll hear it on Fox, you'll hear it on CNN and MSNBC, you'll read about it in the Journal and in the Times. Trump's worst enemy will be his own party. Because what you're supposed to do in economics, when you can borrow at 3% and invest it and get a return of 8%, you do it all day long. That's what we can do. The rest of the world is really willing to lend us money today for 30 years at less than 3% as we speak. Our government can borrow money with a U.S. Treasury, 30-year Treasury, at 2.85%. It's free, literally free. And guess what? Our enemies are willing to lend it to us. China, Russia. Watch what happens when there's any kind of scare in the world. Treasury, U.S. Treasury yields drop. Why? Because we're the safest, most predictable country in the world. Forget about what they're telling you about. We don't know what we're doing. We know exactly what we're doing. The world knows what we're doing. They don't like us, but they know this. We are the deepest capital market in the country. We can handle trillions of dollars of cash. They know they put money in the Treasury, they're going to get it back. That's all they care about. It's safer than gold. It's safer than any other currency. Certainly safer than the stock market. So we could literally borrow the money we need to spend our way out of this problem. And that seems, the press says that's a pejorative. That's what we did in the 1930s, folks. There were 25% of our people were out of work. Now, if you watch the newsreels, you'll see the differences in the approaches. Back in the 30s, people were out of work, they waited on that line and went around the block, around the city, and they were in their little suits, they had blazers, and they had little ties on, and they were reading the paper, they were sharing whatever food they had with the guy in back of them. Not today, it's a totally different deal, and that's what makes this so dangerous. So here we are in a position where we could borrow money, spend it on things that have a real return, infrastructure, dams, roads, high-speed rail, putting our people to work. To the extent they have those skills, they then go from making nothing to making something, and guess what? They pay taxes. And the revenue comes back to the government. Now, I'm not going to tell you that we get it all back. No, it's not going to pay for itself in the short run. It never will. What it means is we're going to have to run bigger deficits. Dirty word, right? Worked in the 30s because of a demand problem. It will work now because we have a demand problem. It isn't the size of this deficit that matters. Whether it's $1 trillion, whether the total debt is $20 trillion as it is today, or $30 trillion as it's likely to be in 10 years. You're being misled by the press. What matters is not how much dollars we owe. I want you to think about this in personal terms. Now, I know some of you, but let me just tell you, if I don't know you, come up to me, Dr. Bob, I owe $1 million. Well, what is he telling me or she telling me about their financial condition? Nothing. If you got a net worth of $40 million and a salary of $2 million, I'll lend you money all day long. I don't care you owe $1 million. Tell me you make $40,000 a year, you got not a penny to your name. That's another story. We're the United States of America, folks. We can borrow all we want, all day long. What's important is not the dollars of the debt. Who's the actor, Devane on TV? He's buying gold. We got a $20 trillion debt. They show you the little clock going up $1 a second or something. What matters is the burden of the debt. You know what people were worried back in the early 80s? What the worry, concern? We had a $2 trillion debt. We were going to fall into an abyss. You didn't want to be in stocks, don't be in bonds. My God, interest rates are going through the roof. Inflation is skyrocketing. We can't borrow any more money. That was when it was $2 trillion. If you let that $2 trillion figure affect your investment decisions, that would have been a huge mistake. It's the burden of the debt. It's the debt relative to your income. Right now, the debt relative to our GDP is about 100%. Under some of the proposals now being made by the government, the Congress, not just the President, when they score those policies over 10 or 15 years and take into account the dynamic effects of the revenue flows and all the rest, the debt ratio actually goes down because the debt is growing faster, your economy is growing faster than your debt. That's what S&P is going to look at when they go to rate our treasuries. The burden of the debt. So for the first time, the thing that makes this the best of times, we are finally talking about fiscal stimulus. Now, you do it differently than we've done it before. To whom would you give the bulk of any tax cut if you want to stimulate spending? Would you give it to the people in this country you know will spend every nickel of what you let them keep? And they are at the middle and the lower end of the income stream. You let them keep it, they're going to spend it. You want them to spend it because then it becomes income to somebody else, it gets respent, the engine starts to go. They're talking about corporate tax cuts, and some of them make sense. I want you to think about some of the arithmetic. $2 trillion of corporate profits is overseas. Not because corporations are mean or unpatriotic. Most of these corporations have to answer to shareholders. It's prudent. Why pay a 35% corporate tax rate when you can pay 10% in Ireland? CEO would get fired if he didn't do it. But if you tell that corporation you're going to be able to get a bonus, if you will, by bringing that money back, we're going to tax you 15%. Well, you know what? I'm not naive enough to think that all of it's going to be brought back. There were legitimate reasons for having cash over there, but at least $1 trillion of it in the Caymans and wherever they put it will come back. What would you rather get? 15% of something or 35% of nothing? It's easy. It's economics is simple. But there's a group in this government that will not borrow that money under any circumstance. It's an ideological thing, not an economic thing. Many of you have sons, grandsons that are in college taking economics now. And if you ask them, what would you do, this is an Econ 101 course, to stimulate an economy suffering from a lack of demand, they will tell you, oh, Grandma, Grandpa, that's easy. Oh, I'd increase government spending and I'd cut taxes. Have a net spending increase because there's a multiplier effect as the money gets spent and respent, and over the years the economy would grow. And that would be the right answer. But there are some that don't care about that. It's almost like a religion. Do not argue with your friends. There is no way on earth you're going to do anything except lose a friend. Just go with the likelihood that after all this discussion is over, after they all vent, after they all position themselves for their constituents, they're very likely to surprise us by doing the same things that they did in the 80s. Now, it's not going to happen overnight because the debate hasn't really started yet, and you're going to one day feel good, one day bad. I'm telling you right now. When Ronald Reagan came into office in January of 81, we didn't get a tax cut till May of 82. That puts any real tax cut, not this August, next year. But the probability now truly exists, where a year ago I couldn't say this and I didn't, that there is a probability, despite ourselves, we're going to do the right thing economically. And I will tell you something. What you saw happen in the market since November, the Trump effect, is investors anticipating a certain outcome based on what they heard was the likely course of policy. It's got nothing to do with whether you're a good person or a bad person. Investing is motivated by greed. You know, Michael Douglas said it, greed is good. But who here would accept less rather than more unless it was pain? It's human nature to do this. It's the way economics works. So what you've seen happen is the market anticipating an event. Now, markets can be disappointed. If this market were to be disappointed for any reason that suggested the hopes and expectations of investors were not going to be fulfilled, I will be the first one to tell you right now, if this happens over the next year, if I am invited back, this will not be a lot of fun. This market could drop in an unprecedented way for a prolonged period of time as markets reassess the course of economics. Is our economy going to grow at all? Will there be a recession? And think of it, the worst possible thing, and here you are growing at 2% a year, is for us to slip into a recession before doing the right things. Because how would you get out of a recession now? By lowering interest rates? You can't go any lower. And with Congress not wanting to spend until it's too late, down you go. that would be the worst of times. And yet here you are, looking into the next 12 months, having to make decisions whether you have certainty or not. This is what you're going to face. I will give you the advice that I gave you every year since I've been here, because I don't know the future. I take this advice myself. Do not take more risk than you personally need to take. I don't care how good this market is eventually. I don't care if you say, that guy made me put 30% in the market, I should have been 100% and I could have doubled my money. That's not for you. I want you to think about your personal situation. If you knew that you could make 30% more in the next year in your net worth, how would it really change your lifestyle at this stage of the game? It probably wouldn't. It really wouldn't. But if I told you, if you're wrong, you could lose 50% of your net worth, I don't care how much you're worth. That will affect how you live, how you feel. Allocate your assets, balance those accounts, make sure you're in, if you're 30% in stocks, fine, don't play games, but have them invested in different areas, growth, income, small cap, large cap. Balance it, keep the risk appropriate for you. If you need a 6% return on your investments to live comfortably, don't take an 8% risk. Don't take a 3% risk, you won't make it. But balance it appropriately. There is nothing like, for an investment person, play money. I hear people say, I just put my play money in. You lose play money very quickly, and all of a sudden you find yourself adding serious money to make up for your play money. Be very, very careful. So what I will tell you is, number one, you're in for a maximum amount of uncertainty as this debate unfolds. All right? The potential is enormous. In 1982, the Dow Jones was at 777. Many people didn't give us a prayer, not a chance. But the government reversed course, addressed the appropriate problem with the right policies, and by the end of the 80s, the Dow Jones was 3,000. We had a recession or two, and by the end of the 90s, it was 11,000. It is now 20,600 or something. I have no idea how high it can go. If they do the right things, it'll be very interesting to say the least. If you're 70, 75, or 80, this isn't really for you. It's not for me. Somebody 30 or 40. Because they can afford to live through a mistake. Because it's the corrections for the mistakes that really make investment opportunities. It's the turn from bad to good, or from good to bad, that give you the opportunity. The hard thing, the difficult thing, is catching the turn. And you know why? Because you gotta act first. If you're first doing anything, you're gonna look stupid. You do something and then tell your friends, oh yeah, I did this. They go, you nuts, don't you know about Trump? The guy's crazy. Don't you know about comedy? They'll think you're nuts. That's when you know you've done the right thing. If you tell them what you did and they say, yeah, me too, isn't this great? It's probably too late. So it takes a little courage, it takes a little foresight. Assess the probabilities of doing the right thing. If you read that after all the debate, they really are coming together with a net tax reduction, net spending increase on productive things that add to our productivity. And I will tell you, with the 30% you may want to invest in, make sure you're in with both feet. Not everything. But if it doesn't look that way, and I don't care whether you're a Trump supporter or a hardcore Republican, protect yourselves. Now, I could go on, and I don't want to, because I know you guys want to get home, you got to go to work tomorrow. But I want you to approach what's going to be going on, this debate, with a different way of viewing it. This is very, very serious stuff. And the outcome will also be very, very serious. I would encourage you now, please, if I've raised any issues, any questions you have, please ask me now. Now, don't go and say, yeah, I really should ask it. If I don't have the answer to something, I'm very quick to say I don't know, and everybody seems to think that's great. I don't know why. So please, I want to thank you for listening to this very short discussion, but I wanted to alert you to this, that this is a turning point, one way or the other. You haven't seen it for 35 years, people forget. They're explosive when they occur. They happen very quickly, and you want to be on the right side of which way this one goes. I'm not smart enough to tell you, but I know what to watch. And if something goes sour or you think so, you tell Albert, he'll get to me, and we'll discuss it together. We're going to go through this together. So again, thank you so much for the invitation. I wish you all the best in whatever you're doing. And I will take questions now if there are any. And I'll repeat them.
All right,
thank you.
Before we take questions, I must interject the rules of interrogation here. If you have a question, we'll call on you. You stand, you identify yourself, you articulate in the King's English, or the Queen's English, I guess is Queen. And then we'll take the question as they come. So, I think I see out of the corner of my eye Jane Curtis. Jane, would you mind standing up and asking a question?
Thank you. Could you expand a bit on your comments about fiscal policy? Because during the Greenspan years, fiscal policy was a dirty word. And I'm interested in how you see that it's come back and how you think it's going to manifest itself.
Sure, it's a very good question. By the way, one way to guarantee you get no questions, make people stand up and identify themselves. It's very simple. Again, in the 80s, we faced a very serious problem with supply, not demand. The whole idea was, how do you get people to produce, invest, save? And so while you cut taxes then, to whom would you give the bulk of the tax cut? To the savers, the producers, and the investors. The upper end of the income stream. When they told you that they gave the wealthiest people in this country the biggest tax cut in American history back in the 80s, they weren't lying. They did it, but they did it for a reason. The problem with monetary policy, and that would be Alan Greenspan, now is Janet Yellen, is that in order to stimulate the economy, we were relying recently, the last 8 years, solely on the Federal Reserve Board's ability to push interest rates down to encourage you to borrow cheap money and spend it. And guess what? It didn't work. Not just here, but all over the world. So what do? When monetary policy is impotent, there is no choice, given our position in the world, but to use fiscal stimulus. And that means more spending, less taxes to the people that will spend it, get the spending. But that does mean, to be effective, borrowing more money, and that's going to be the catchphrase. We're going to, borrow too much money. My guess is, and it's a guess, in the end we're going to do it. And I'll tell you an interesting thing to watch. The new Treasury Secretary, Mnuchin, I guess his name is, it's a Wall Street kind of guy. You know what they're talking about now? Borrowing money, the U.S. Treasury borrowing money for 50 years. 50. In other words, locking in these low rates we haven't seen since the Depression, not for 30 years, for 50 years. Now, you want a little, tip-off that they're going in the right direction. Listen for that discussion. You pick up on it. Most people aren't aware. 50-year bonds. Incredible. So, to answer the question quickly, if you don't get fiscal stimulus, net stimulus, the odds are going to go against us. We're going to get out of this problem. Listen.
Gary Holmgren, you said earlier that in 1981 they did what you're suggesting that they're about to do again, right? And that the Dow Jones was at 777, and that by the end of the 80s it was up to 3,000. but they lowered the interest rates in the early 2000s, mid-2000s, and then the Dow went from 8,000, if I'm not mistaken, to where we are today, 20,000. How did that not work in this period of time? But in your opinion, how is that wasn't an effective strategy?
That's a great question. I thank you, because that's an economist's dream, is to get a question like that. When they lowered interest rates like that, since they weren't able to stimulate demand, what happened was the money markets were separated from the real economy. The money went somewhere. It didn't go into spending for goods and services. It went into financial assets, stocks, bonds. That's what happened to that money. People didn't borrow it and buy a car necessarily or build a house. They put it in the financial assets. There was a severing of the link between the financial markets and the real sector of the economy. Monetary policy became ineffective, and even though rates were coming down, it didn't result in increased demand the way we're taught to think it works all the time in the textbooks. There was a liquidity trap. This is very common in economic literature. There came a point where interest rates could not be pushed low enough to encourage people to borrow for spending, but the money went somewhere. People borrowed the money, they went into some crazy stuff. Because as you know, interest rates, things happened in 2008 that a lot of us would rather forget because of the dislocation, if you will, of the flows of capital. And the Fed became impotent. And now what's the Fed talking about? Raising interest rates when the economy is still very sluggish. It's like putting friction into an economy. It's harder and harder to move ahead when rates are going up. To offset any monetary restriction, you need fiscal ease. The question is, and we can talk about this all day long, is are we likely to get it? And there'll be always somebody on the other side of the argument. That's where there are buyers of things and sellers of the same things. If I buy a stock today, you know what I'm thinking? I don't believe he sold me that at this price. That's great. You know what the person selling me is saying to himself? I don't believe he bought it at this price. That's the market. So it's a great question, but it's that severing of the link that's very rare. It happened once before that I'm aware of in the 30s. When interest rates fell to nothing and we still couldn't get out of the morass, what did the government do? TVA, CCC, WPA, they put people to work, give them a paycheck. You know what they were telling them? They said, look, pay a guy to dig a hole. Pay his friend to fill it up. We don't care about what they're doing, but they're going to spend the money on somebody that does produce something. A suit, go to a restaurant, put them to work. And the other thing is this, and I want you to know this. You know, you're here with $20 trillion. Who's going to lend us any money? You know what makes us unique in the world? We don't like to say this because we're kind of pushing it everybody. We can print our own money. I want you to think about it. If you could go to a restaurant tomorrow night, and when you're done with a wonderful meal, you tear apart of the napkin and you write your name, Maggie, on the napkin. And the waiter took it in payment for the meal because they knew they could tear off a little piece of Maggie and give it to the busboy, who would take it because he knew he could tear a little bit of that and give it to somebody else because they would take it. The world has no choice but to use our dollar. And until that stops, and it will not be in our lifetime, so don't let that affect what you do. They worried about it 40 years ago. They have no choice. And you hear, oh, we're printing money. If that's what needs to be done, if we do it, the financial outlook will bright. The question is, are we going to do it?
I have to say, they do that in Italy all the time. They just print the money.
Italy can't print it like we can because you can stop buying the euro. Yes, sir.
So I'm trying to get my hands around $20 trillion of debt. I think you said it equaled 100% of our GDP. So
Correct.
we're producing $20 trillion a year in goods and services. Is that correct?
No, that's how much we owe the rest of the world. We're paying
What
interest
do
on
we
that.
produce in a year? Isn't it around 3
Oh, I see what you're saying. Yeah, we produce $20 trillion a year in gross domestic product.
We do.
Yes, that's the 100%.
So that's the 100%.
Correct.
Because I had heard a figure that was far lower than that.
Oh, no.
I was imagining we're basically bankrupt.
No. I'll give you an example. Japan owes 250% of their economy. Okay?
That was my next question. How do we rank compared to some of the other major countries out there?
We're up there, but with one difference. The world has no choice but to accept that debt. Do you know what the worry was during the Clinton years when we ran a surplus for 4 years? You think a surplus is so good? A surplus means you're taking out of the economy more than you're putting in. A deficit is you're putting in more than you're taking out of. Vice versa. It's the opposite. Neither one is good. Over a long period of time, you want a balanced budget, but not cyclically. So what you will find is if they tell you in the next 10 years we're going to add $10 trillion of debt, that would amount to maybe 2 or 3% growth in your debt over time. But if your economy in dollar terms is growing 5 or 6%, the debt ratio goes from 100 to 95 to 90. All of a sudden, S&P says, no, you're not AA plus anymore. The United States is AAA because of our ability to pay it down. That will kill a lot of folks when they hear those numbers. 20 trillion, you can count.
We'll never pay it back.
No, of course not. And the world doesn't want it. No,
there's no
you won't.
chance, right?
And the world couldn't exist without it. They need the liquidity. The concern during the Clinton years is, my God, if the U.S. pays off its debt, where are we going to put our money? That's the difference. People don't know it. The debt isn't the issue. The issue is, will we spend enough to elevate our growth rate to an inflection point where no longer are we stuck in this 1.5%, 2% growth rate to 2.5% or 3%. What happens to earnings, I can only tell you. All of a sudden, earnings year-over-year comparisons start to go up. The multiples of the market, which you hear about, that's just a measure of confidence, goes up. So you're compounding rising earnings with rising multiples. My goodness, you could sound ridiculous when we talk about some of those numbers. Do you know what happened in the 5 years between 95 and 2000 because of the combination of rising multiples and rising earnings? The S&P went up 20% plus per year, 5 years in a row. That can happen, but the uncertainty is huge. I'll take one more.
Well, actually, two more, if you don't mind.
Two more, so I'll stay
Ken
on.
Nielsen and then Tony.
Yeah, I had a question. Maybe you can explain where that money that they use for quantitative easing is and what impact. It seems to me that's like, the 800-pound gorilla. There's trillions of dollars out there that's going to affect the economy, and nobody talks about it. Like it doesn't matter, but somehow it seems to me it matters. Maybe you as an economist can explain.
Well, let me tell you, basically it goes to the question there. That quantitative easing, 1, 2, 3, what the Fed basically did was buy bonds, mortgage bonds, treasury bonds from the banks to give them more money to lend, so that people could buy cars and boats or whatever they do with the money, houses. Instead, people borrowed the money and they invested in financial assets. It didn't get into the real economy. There was like a wall there. So where's that money? It's in the equity markets. In the bond markets.
Is it in a deficit, or what we owe from borrowing all of those bonds is, in addition to the $20 trillion we have in a deficit, is this other stuff that we owe to the people we
No, the other stuff we owe, the numbers are so big. Social Security, the underfunding of Social Security, Medicare, you're up near 100 trillion.
Yeah. No, but I'm saying, just
Where's the 4.5
that quantitative easing, does that show on the balance sheet anyplace?
It shows at the Fed's balance sheet.
But it doesn't show,
No,
it's
sir.
in addition to the 20 trillion we owe, this other stuff that nobody's
Well,
quantified we owe.
Not really, because that 4.5 billion bought treasuries that the Fed is issuing. The 4.5 trillion bought treasuries when the Fed issued bonds. Basically, the Fed bought them, not me, not the banks. The Fed bought them. So it's there on the Fed's balance sheet. There's an asset of 4.5 trillion on the Fed's balance sheet. Who's got the money?
Yeah.
The banks. And the banks lend it to people who use the money they're borrowing to buy stocks and bonds. And that's why you've got yields where they are, so low, which is what the Fed would like. And that's why you have the stock market so high. And if all of a sudden they try to unravel it, which is what they're going to try and
They said
do,
they're going to try to do that.
they will put upward pressure on interest rates. All things equal, that's going to put pressure on the markets, right? By rates go up, bond prices go down. Rates go up, stocks got to compete with those higher yields, right? The only way the Fed can remove those funds without dislocating the markets is if investors see real growth on the other side, which in effect means higher earnings.
How much money are we talking about?
Ken, this is like your seventh question, Ken. I mean, you're really milking this now. Anthony.
He's not going to answer.
Hi, Anthony Kelso.
Yes.
One of the important aspects that we're talking about is spending to get the economy going. What does the government need to do, in your opinion, to help the young generation that we have that's buried in student debt, and their interest rates are at 10 or 11%? They're not able to spend. They're the generation that does spend. How do we get this economy going?
Well, you bring up a very good point. You know, there's the short term and the long term. Most people think in terms of the short term. The answer is education. That's a lot of years. It takes a long time before you see people learning skills that are going to be useful in the 21st century. And so maybe you don't automatically have people going to college. Let them be the best plumbers and electricians, whatever it takes. I mean, you shouldn't look down on somebody. So it's education is the answer. The investment we should make is in education, but it's a long-term process, and I don't know we have the patience for it.
But it's those students that now have graduated, that now have $50,000 and $100,000 worth of student loan debt. We need to get them some relief. So that
Well, you do, but that comes from somewhere. Look, I agree with you socially, but economists tend to be very mean people. We do. It's a heartless kind of thing, but we are. If you forgive the loans, somebody takes a hit. If you lower the interest rates, somebody takes a hit. Will there be people that advocate it? Yes. There are some that say, you know, we need to cleanse the system. Let's just go for, let the thing collapse and start from a new beginning. What do you do for them? The honest answer is, you're not going to do much. That's the honest answer. But in the right environment, they can earn their way out of it. Refinancing happens all the time. If they can fit into the new economy, if there's a job for them doing something where they can pay that back, they'll do it. You know, 100 grand today is a lot of money. 20 grand 40 years ago was a lot of money. Yet people were able to do it. One of the problems we face, which I don't know the answer to, is we have a mismatch now between the skills this economy requires and needs and the skills that people have. I mean, there are guys going to college today majoring in subjects for which there is no demand. They get A's and B's, and they come out of college, and what can they do? I mean, I had a secretary, I love this woman. She's a secretary. She was my secretary for 15 years. Her son was a baby, went to college, and he called me and said, Dr. Bob, you got to help me in my class. You know, I'm having a little difficulty understanding this. I'm majoring in gender studies. And maybe I'm a little old, so I said, what the hell is gender studies? And he tried to explain it to me, and I really wasn't getting it. I said, what are you going to do as a specialist in gender studies when you get out? I don't know, but I don't know what I can do, but I'm going to graduate with good grades. That's a problem. And nothing fixes that kind of problem like people realizing it was a mistake. Yes, ma'am.
Hi, Lisa Westerfield.
Hi, Lisa.
I'm curious because we talked about the need to stimulate the economy with more spending, but there's more and more compression of wage earning at the middle class and lower class levels. So if that's like the majority of the people, where is this stimulus going to come from?
Good question. What you have is, if you borrow the money to spend on things, so it creates demand for carpenters and ditch diggers, whatever it creates demand for. Supply and demand. If the demand for labor is going up against the restricted supply, and you've got to get these folks, what are you forced to do in this marketplace? Raise wages. It happens. But you've got to get the demand for these things started before you see the secondary effects on wages. That's what happens. And I'll tell you something else to look for. Right now, I think 61% of our population is counted in the labor force. If you drop out, if you decide you're not going to look for work anymore because it's hopeless, you don't count anymore. You're not there. The participation rate is very low. What you're going to find is, if the economy starts to grow because of this fiscal stimulus, the first thing that's going to happen, watch for it, the unemployment rate is going to go up. Sounds strange, doesn't it? You know why? Because all of a sudden, this unemployed person who wasn't even counted is going to say, wow, there's an opportunity. I'm jumping back in. I'm going to look for a job. All of a sudden, the labor supply jumps. In the short run, the unemployment rate will pop up. That is a very good sign. It doesn't mean we're falling apart. If it happens because the participation rate is increasing, that's a whole different way of looking at what's going on. So the answer is, pressure on wages occurs when the demand for those skills increases, and the demand for those skills increases only when the demand for the products that those skills produce goes up.
The executive director is going to exercise his prerogative, but after one final question from Mr. George Canis.
Thank you.
All right, you got to remember, this guy is in the business, and I get questions from these guys all the time, so it's going to be very complicated.
No, I'll make it easy for you. Actually, I've known Bob, been listening to stuff for 35 years, so it's really a pleasure to have him here tonight. Thank you, Albert, for inviting him. That gentleman's question on the student debt, I've always felt, and the issues are, social and moral and so on, but just from an economist standpoint, if you eliminated student debt, that seems the section of the population that can't have family formation, can't buy homes, and so on. And it seems like the Federal Reserve would have done a better job, to your point, about getting money into the system to people who would spend it as opposed to invest it, if they did something in that. So I'm just curious as to, I know that socially, morally won't work, but economically it works well.
Problem with monetary policy, it's like a blunt instrument. You can't focus it. There's no way to aim it. You lower interest rates, money's going to flow somewhere based upon expected return. And so the Fed can't direct where the banks lend the money. The banks do. It's a free market. They do what they want to do. They're looking at their profit motive. And if you let markets deal with this, so you're going to have an unbelievably difficult social situation. Markets can be brutal. They don't care. They don't make interpersonal comparisons. They don't care whether you're male or female, black, white, pink, green, yellow. If you're producing, you get rewarded, and if you don't, the markets won't feed you. So it's a very difficult act. It's hard to balance. Don't look at the Fed to do this.
I wasn't looking at the Fed.
No, I'm just saying, banks can't do it. CEO would be fired immediately as their earnings took the hit, as they wrote off the loans and they said, you're a nice kid. Forget your $100,000 loan. You're gone. The answer now is fiscal stuff. I'll leave you with this. Fiscal stimulus. And I mean on good stuff. Roads, bridges, high-speed rail, things that down the road have a return, where trucks now can get down the road quicker and more efficiently. Technology is going to help us in this regard, but it's going to be demanding different skills. And if you have a tech boom like we've experienced, you majored in gender studies, they're not going to be looking for you. Unfortunately, they're not. They're going to be looking for somebody who's savvy in technology, knows how to use a computer, math. It's just a whole different world. But I gotta tell you, not since the early 80s, when we were talking with each other, have I seen, and this is all it is the potential, something I didn't say last year, the potential for something explosive for investors in a very, very positive way. And I couldn't be more delighted to share that view with you tonight. I want to wish you all the very, very best of luck. Thank you.
Thank you, Robert. The prerogative of the executive director is to kind of a postscript to Dr. Goodman's comments, not only tonight, but to give the audience a flavor of the past several years for all the new faces in the audience. I personally have seen the age-old struggle between fiscal and monetary policy played out at every local meeting of any city or county IDA. And I was recently a guest at the Home Builders and Remodelers of Fairfield, where the mayor of Norwalk, who, by the way, bears a remarkable resemblance to Kirk Douglas. If you're in Norwalk, by the way, and you see somebody who you swear looks like the actor Kirk Douglas, it's the mayor of Norwalk. And the mayor of Norwalk was up there in a government forum of legislators, much like we have here every year in election time. And he was explaining to the audience how the city of Norwalk, through spending on infrastructure and economic development, whatever, and selling bonds, is trying to create the demand and create the business that will help the city. Then there was an alderman or somebody else from the city government who was complaining about the deficit in the city and how, you know, maybe they shouldn't be spending that much on job creation and infrastructure and whatever, and that the deficit was all important. And really this struggle plays out not only over history and of this country, but in literally every town, village, and city that is trying to grapple with their own local economy. So I had to share that in talking with Robert earlier, and he was kind of reminding me of this, you know, as he stated, this balancing act that faces really all levels of government. So anyway, again, I want to thank Dr. Goodman. Oh, by the way, thanks to, and I'm sorry I didn't mention this earlier, but thanks to Levitt First as our event sponsor for tonight, our insurance manager for our safety compensation group. And thanks again to my colleagues Jeff and Maggie for all their help in making these events possible. And don't forget to leave your name tags at the table there for our monthly drawing. Safe home, everybody, and see you next month. Take care.